Hi, I'm John Prasinos, Editorial Director of Investing Daily, with a video presentation for Monday, January 9. To view our full range of trading services and publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. The new year started with a bang as U.S. and international equities closed out the first trading week of the year sharply higher. It was a welcome rally after ending 2022 on a dismal note. Can the momentum last? No one can say for sure, of course. Trying to time the market is a fool's game, but the underlying indicators are auspicious. That said, investors have been whipsawed by the mix of good news and bad news. Complicating the picture is the lens through which Wall Street interprets data. Good news can be seen as bad and vice versa. For example, in the early part of last week, stocks fell as data showed robust job openings and falling initial jobless claims. But later, stocks surged in the wake of a report that showed wage growth is cooling. Until we get closer to economic equilibrium, this volatility is likely to continue. So far, though, the trajectory has been positive. Take a look at the following chart. For the week, the Dow Jones Industrial Average gained 1.5%, the S&P 500 gained 1.4%, and the tech-heavy Nasdaq gained 1.0%. The MSCI EAFE, which measures international equities, gained 0.9% as global investors were cheered by falling energy costs. The Department of Labor reported last Thursday that in the week ending December 31, seasonally adjusted initial jobless claims hit 204,000, a decrease of 19,000 from the previous week's revised level. The reading was harder than the Fed wanted, because it showed that the tightening of monetary policy to fight inflation still had a way to go. Last Friday, the Bureau of Labor Statistics, BLS, reported that total non-farm payroll employment increased by 223,000 in December, and the unemployment rate last month fell to 3.5%. That reading also was stronger than the inflation fighters wanted. But the data came with a huge silver lining, and it propelled stocks higher. The BLS reported that for the month of December, average hourly earnings rose by 0.3%, less than the 0.4% consensus estimate. Average hourly earnings growth slowed from 4.8% year over year in November to 4.6% in December. The December level is down from a peak of 5.6% in March. For the past 3 months, wage growth has been running below 5%. The latest reading of 4.6% for December was the lowest since August 2021. Over the past 3 months, wage growth has run at an annualized pace of 4.1%. For inflation fighters, we're seeing further good news in declining crude oil prices. Recession fears, slowing demand, and persistent COVID woes in China are weighing on oil prices. The per-barrel prices for West Texas Intermediate, WTI, which is the U.S. benchmark, and Brent North Sea crude, on which international oils are priced, hover below $80 per barrel. That's a disinflationary trend. It's notable that oil has been on a downward slope despite the efforts of OPEC Plus to curb production. It's a reminder that the cartel has only so much power, and macroeconomic forces can overwhelm the policy of its oil ministers. Meanwhile, the ISM reported last Wednesday that economic activity in the manufacturing sector in the U.S. contracted in December for the second straight month, following a 29-month period of growth. The December Manufacturing Purchasing Managers Index came in at 48.4%, 0.6 percentage point lower than the 49% posted in November and beneath the estimate of 48.5%. That's bad news, right? Nope. Wall Street was heartened because it showed a slowing economy, which in turn dampens inflation. At the same time, the numbers didn't reflect an economy that's falling off a cliff. We're not exactly in Goldilocks territory. That would be an overstatement. But this uneasy balance is serving several purposes at once. Jobs growth is resilient, but wages are falling. Manufacturing activity is contracting, but not signaling an outright recession. It's the sort of backdrop that has contributed to the fall last week in the benchmark 10-year Treasury yield. As you can see, the yield racked up a significant rise throughout 2022, but now it's been dipping downward. Now let's look at the week ahead. Fourth quarter earnings season is set to begin during the second full week of January, which is this week. The consensus estimate is that Q4 earnings will decline by 2.8% on a year-over-year basis. In the coming days, keep an eye on these salient economic reports. Inflation expectations scheduled for release Monday. NFIB Small Business Index Tuesday, Consumer Price Index CPI and Initial Jobless Claims Thursday, and Consumer Sentiment Friday. After a terrible 2022, we perhaps face a more bullish 2023, with the economy slowing just enough to curb inflation, but not enough to wreck corporate profits and equity prices. The economy is downshifting, but not screeching to a halt. And don't get spooked by the political turmoil in Washington. The political circus that surrounded the speakership vote, well, in the end, it means nothing. Wall Street often prefers gridlock because it lessens the chances of Congress passing legislation that hurts investors. It's part of that bad news can be good news dynamic I was just talking about. Well, that's it for now. Thanks so much for watching. And if you have any questions or comments, please don't hesitate to send me an email at mailbag@investingdaily.com.